The market just dropped 15% in 2 weeks. Your portfolio is bleeding red. Your stomach is in knots, and every fiber of your being is screaming, "Sell everything!" But here's the thing. This moment right now is exactly when your wealth is made or destroyed. Today, I'm going to show you how to stay consistent when the market drops, because the investors who master this skill are the ones who build generational wealth. Market downturns are inevitable. They're not bugs in the system, they're features. Since 1926, the S&P 500 has experienced a correction of 10% or more, roughly every 1.5 years. Yet despite this predictable pattern, most investors panic and make the exact wrong moves at the exact wrong time. The average investor returns about 3% annually, while the market returns 10%, and this behavioral gap is the main culprit. Strategy number 1, reframe your perspective. First, you need to mentally reframe what a market drop actually is. When stocks go on sale at the grocery store, people get excited. When stocks go on sale in the market, people panic. This is backwards thinking. Market drops aren't disasters, they're opportunities disguised as problems. Warren Buffett puts it perfectly. Be fearful when others are greedy, and greedy when others are fearful. Every major fortune in history was built by people who bought when others were selling. The 2008 financial crisis, the dot-com crash, the COVID-19 drop, these weren't just market events, they were wealth transfer events from the panicked to the prepared. Strategy 2, have a written investment plan. Consistency comes from having a plan before emotions take over. Your investment plan should include your timeline, risk tolerance, and specific actions you'll take during market downturns. Write it down when markets are calm, not when they're chaotic. Include specific triggers. If the market drops 20%, I will invest an additional X dollars. I will not check my portfolio more than once per week during volatility. I will continue my automatic investments regardless of market conditions. When emotions run high, having these predetermined rules removes the guesswork. Strategy number 3, dollar cost averaging on steroids. Regular dollar cost averaging is great, but strategic dollar cost averaging during downturns is phenomenal. If you're contributing $500 monthly to your investment accounts, consider temporarily increasing this to $750 or $1,000 during major market drops. This doesn't mean going into debt or risking money you need for essentials. But if you have extra cash sitting in savings earning 0.5% while the market is offering quality companies at 30% discounts, you're missing a massive opportunity. Strategy number 4, focus on time, not timing. Here's a sobering statistic. If you missed just the 10 best days in the market over the past 30 years, your returns would be cut nearly in half. The problem? Those best days often happen immediately after the worst days. When you sell during a downturn, you risk missing the recovery. Think in decades, not days. Every single 20-year period in stock market history has been profitable. Every single one. Your job isn't to predict when the market will recover. It's to be invested when it does. Strategy number 5, use the 2-bucket system. Keep your money in 2 buckets, short-term needs and long-term growth. Your short-term bucket should have 6 to 12 months of expenses in cash or stable investments. This money protects you from having to sell investments during downturns. Your long-term bucket should be invested aggressively in broad market index funds. When markets drop, this bucket will fluctuate, but you won't need this money for years or decades. This separation removes the emotional pressure to sell when markets get scary. Strategy 6, study market history. Knowledge kills fear. Spend time studying previous market crashes and recoveries. The market has survived 2 world wars, a Great Depression, multiple recessions, terrorist attacks, pandemics, and countless geopolitical crises. Each time, it recovered and reached new highs. The S&P 500 has never failed to recover from a bear market. Never. This doesn't guarantee future performance, but it provides valuable context when your brain is catastrophizing. Conclusion. Market consistency isn't about having nerves of steel. It's about having systems that work regardless of how you feel. The investors who build real wealth aren't the ones who never feel fear. They're the ones who feel fear and invest anyway. Remember, market drops are temporary, but the habits you build during them are permanent. Every downturn is practice for the next one. Master this skill, And you'll not only survive market volatility, you'll profit from it. The next time the market drops, don't ask, what if it keeps falling? Ask, what if I miss the recovery? Because history shows us that recoveries always come, and they belong to those who stayed the course. If this helped you think differently about market downturns, hit that like button and subscribe for more investing strategies that actually work. And tell me in the comments, what's your biggest challenge when markets get volatile? I read every comment, and your question might become my next video.